Welcome back and Happy New Year. One thing we know about this year is it's going to be very different than last year and different than the past couple years. We were previously in an environment where we had stimulus money, we had high consumer savings, we had growing earnings, we had expanding profit margins, we had companies that could take price. We're no longer in that kind of environment. We're in a higher interest rate environment where people are incentivized to save. They're getting a return on their cash for once. There's going to be less cash. Money supply is coming down. Liquidity is being drained out of the system. Money is being drained out of the system. Inflation is likely peaking, which means companies can no longer get away with taking price and growing the revenue, growing their earnings that way. And it's a completely different environment from where we were at the peak and where some stocks are still kind of demonstrating they should be. Let's take a look at what has actually changed thus far and then what is going to change going forward. What has changed thus far is we've gone to a very high historical multiple, which kind of makes sense when yields are basically zero, but yields are no longer basically zero. So we've gone from a very above average historical multiple, and we've come down to about an average historical multiple. Rates are, if you really go back in terms of all history, still relatively low. However, it's reasonably safe to assume that they're going to go higher because currently the market is anticipating cuts by the end of the year. And I can understand why. The market's fearing a recession. They think the Fed is going to react very quickly to a recession like they have in the past few recessions and will cut rates quickly and dramatically. I don't think this is the case. And the reason why I don't think it's the case is because if you look at the Fed dot plot from the last meeting, they have rates high not for 2022, not for 2023, not for 2024, but for 2025 and beyond. They have a high long-term rate. At least there are some members more than there were previously. I think that says a lot. I think that says rates were incredibly low. We saw a world where, there were all these explosions in financial assets, but we ultimately saw productivity in this country fall. There were problems that occurred with this. We saw tremendous gains in the stock markets. We saw tremendous gains in tech, but we also shipped a lot of our production to China. And that's not what this country was about. This country was about the best goods, et cetera, et cetera, et cetera. And I think we can get there. And I think the Fed wants to get there. And I think one of the ways they think we're going to get there is through not having low interest rates. I mean, look at what's happened with Japan. Their stock market really hasn't done anything for 30, 40 years. They're still a big economy, but they're having their own problems and they're having to do some stuff in the bond market. So low rates, negative rates, these things might not come back. I'm not saying rates are going to go to 100% because they're not. But I think there's definitely a little bit of a paradigm shift here going on. So to make a long story short, I do expect some earnings to come down. I definitely expect growth rates to come down, and that was kind of what was keeping multiples very high. I still think there are areas of the market where multiples need to normalize. You guys have heard me talk about Apple, for example. We are short this position. Apple's still well above a historical multiple. I'm not saying it's not a good business. I'm not saying they don't make good products. I'm saying the stock is priced at an above average historical multiple. And it has, in my opinion, a lot to do with low rates, people not wanting to buy bonds, and looking for alternative safe haven assets. I think that is safe to say that people are viewing Apple, Microsoft, Amazon, etc. as safe haven assets during COVID and not buying treasuries. There is no alternative. You've heard about the TINA trade. Well, the TINA trade went to mega cap tech, and that's why they're getting hit particularly hard here. So We definitely want borrowing. We definitely want borrowing and lending. We don't want just inflated multiples of massive tech companies. Okay, tech companies are great. Okay, I'm not talking about tech companies. But we also want incentives to lend money and for that to be a thing that people do so people can go out and invest in domestic production, high intensity capital projects, things like that. And yes, low interest rates makes it beneficial, but if you're doing that kind of thing, you're not looking for a 3% return, you're looking for a 100% return. So whether or not rates are at 2 or 5% doesn't matter, but it's definitely a good thing for people to save, for families to save, to have nest eggs, to lend those nest eggs out. Nothing wrong with that, especially when it's used for U.S. purposes. So I think there's more to the Fed goal rather than just seeing inflation peak and immediately going straight to super low interest rates. I think that it came to bite them in the butt. They thought they were going to get away with this. They thought they were going to get away with transitory inflation, etc. Ultimately, what happened is we got a widening wealth gap, tremendous wealth for incredibly wealthy people. I'm talking BlackRock, Blackstone, this type of stuff. And we saw inflation for everyone else. Mostly everyone else, okay? There's I come from a wealthy family, but we're not that wealthy, okay? So we fall into the bucket, like probably many of you, where our parents did well for themselves, but we would not consider them, having generational wealth or anything like that. My parents didn't really give me anything at all. I got a relatively small stock account when I was 18. My brother didn't get one because my parents were saving for college, and at one point they got to a point where they didn't need to save for college anymore. But it wasn't that simple. Anyways, tangent, regardless, whatever. It's going to be a different environment. I've laid out a number of things to consider and to use to adjust your paradigm. What are we doing? We're still bullish on energy. We see days like this, and there are plenty of stocks we still like that we think are well priced. We don't have Exxon right now, believe it or not, at the right price. If there's enough of a pullback, we'll get there. But I think Exxon is still relatively cheap, especially compared to the whole market. The IEA, for example, International Energy Association, EIA, the US version of that, expects oil production to peak in 2035. So that means it's going to grow basically, it's going to grow every year until 2035, according to them, and then peak. Everyone's concerned about, oil prices are down, Exxon earnings. I understand that. That's very understandable. The best way to figure that out, to determine how much of a concern that is to look at the oil prices last quarter and the oil prices in the equivalent quarter of 2021. The prices in last quarter were still a little higher than the prices in 2021. We also consume more oil in Q4 2022. So my prediction is Exxon is still going to earn somewhere around $10 to $12 billion for that quarter. If you, annualize that and then price earnings it, you get about a 10 PE with a big dividend. That is a very good proposition compared to Apple at a 21 or so PE with a very small dividend. So these are things to consider, market dynamics to consider, prices to consider. There are stocks that are even better priced than Exxon that we have. I'll give you a name. We have it. CNQ, Canadian company. We like it. Big dividend. Relatively good PE. Relatively resilient and stable earnings even throughout the swings in oil prices. So we're continuing to buy that stock on days like today. And we'll ultimately see what happens. We like other commodities, silver. I was talking to somebody who works in Washington, D.C. around energy and utilities and helping utility companies plan out the next 20 years in terms of purchasing energy. And this person said that Solar is very difficult right now. They're experiencing supply chain issues. They're having to declare force majeure. So I took a look at it. I looked at silver as an asset, benefits from solar, $1.7 trillion, whatever, Inflation Reduction Act, gonna go into solar, I assume a good amount of that. Probably more demand for silver. Silver otherwise is a pretty good inflation hedge, storehold of wealth. It's used a lot in industrial production. It's gonna adjust if they print more money, although I don't think that's gonna be the case. I think that's a pretty good place to put some capital. I would definitely be patient here. I would definitely be acknowledging a variety of risks and uncertainties for the first few months of this year. We're kind of approaching an inflection point where we may get peak inflation. We don't necessarily know what that means for companies, for the economy, etc. We may have hit bottom unemployment. We might begin to see a tick up in that. If you look at how unemployment reacted in the 2008 recession, it developed slowly and then suddenly. Are we going to get a sudden move? We'll see. There's a lot of different things that are going to happen right here. The best thing we can do, in my opinion, watch videos like this, stay on our toes, but be patient and see how things begin to play out. We've got our theses. We've laid out why we're avoiding certain areas, why we're short certain areas, why we're long certain areas. We've done that. We have certain convictions, but we're not going to stay in these convictions forever. We're going to change. We're going to cover our shorts. I've already covered some shorts. I would have loved to stay short Tesla, but I covered that too early. Is what it is. I'm not perfect. We're still short other stuff, but at some point, we're going to cover the shorts. And at some point, we're going to go long. So those are the next kind of steps, but we're not there yet. We've laid out why. So we're going to keep on our toes, keep looking, see how things develop, and adjust accordingly. So continue to watch these videos every day, because every day, hopefully, I'm either going to reiterate what I'm thinking or provide you with something new. So you'll know how I'm thinking. And last year, we were up 120%. So that's today's video. And until next time, peace out.